Hello, everyone. Welcome back to a brand new session of Decoding Market. Every candle tells a story, every move hides a message, and the market, it never speaks directly, it leaves clues. Welcome to Decoding Markets, where we go beyond headlines, cut through noise, and uncover what's really driving price action. Whether you are a trader looking for your next edge or an investor trying to make sense of the madness. This is where you will find the clarity. Today's session is all about understanding market in real time. No recycled theories, not beating around the bush. Just what matters now and what will come next. So, welcome back, sir, to a new episode. It's a pleasure to have you again, sir.
Pleasure
So,
to speak.
after a run, not a run, just a pale walk in the market. There is no run, there is no nothing. So, what do you say about the current market situation, sir? The first
The truth
scenario,
about the market. Yeah, the truth
right?
about the market is that broadly it does not want to fall. So far, Nifty is the only thing falling, which is the smoke screen. It can be justified by saying that large cap earnings are poorer than mid cap earnings. But even then, the saddest part of the story is that ever since India Park attacks ended, the war ended, and we came out on top. The Pakistani stock market is at an all-time high, and we are not. That saddens me. So
Okay,
we better get there just for that one reason. uh,
got it.
no, having said that, the Nifty and Bank Nifty have both retraced 61 to 66% of the June to July rally in the sell-off, and then bounced from there in the last 3 days. So it's a very good level. It fits the idea that I've been saying that this is wave two of three. We've had a lot of arguments, counter arguments on the Indiacharts platform on the subject. A lot of debates on whether the entire rally from April is an X wave, not an X wave, and so on. But I'm sticking to my view, which is that we bottomed in April. We are not going back to those lows, and all the fear is just interim. It feels like things can get bad, but at the end of the day, they are not getting worse than they were before in terms of price action, right? That's what gives us the first clue of what is going on. And when we compare world markets, most of them have done exceedingly well, and they have done well. And now all the more with some of the trade deals being announced. It actually started with Jakarta some time back, and they got 20%, and then their market rallied, and it had rallied into the news, and then further rallied after that. Now you're seeing Japan accelerate, okay,
Right.
and you're seeing a pickup in Chinese stock markets. So a lot of things happening one after the other. So the question left is, oh, then why not us? What is wrong with us? Is it only the tariffs? So it's a mix of the earnings season and tariffs, but many other markets have discounted that and moved ahead. So again, why not us? So there is some negativity, and that negativity partly coming, I think, from foreign investors, because after all this, and our rupee also stabilizing or at least stopped weakening, I would have expected some foreign inflow into the market post the April postponement of the tariffs. But foreign investors continue to be sellers in the cash market, and they have created probably the second, I think it's the second largest short position on record in the index futures. Okay, so this negative sentiment is being created by foreign investors. Uh, to this extent, reason unknown, because we are not at 21,800 anymore. We are at 25,000, and they're still shorting the market like anything at this level. Uh, Contrary thinking tells me that we can easily generate a short-coming rally if nothing bad comes out of this. And the Japanese announcements have created hope today that something will eventually happen even for India. Except that it may take time. The only thing people are saying is that it could get postponed till September. till the oil announcements also have to kick in, where they're putting sanctions on Russia on oil imports, and they want India also to lower the ceiling on oil prices that they import with, and that should bring down what we buy. I mean, bring down prices at which Russia sells, and so they're trying to really hurt that idea, trying to control Russian sales of oil. So that I think remains a contentious issue. But if we just put that aside, then we could have a good deal. But let's see. That's so the positive news can be a
Yeah.
trigger, but when will it come? So if the news doesn't come immediately, can our markets keep falling, or should they keep falling if we just remove all this noise? The fact is they are not falling. Okay, so like I said, broad market, mid, small cap stocks are doing well. There is a strong domestic story that investors are buying into. There is liquidity both with mutual funds and banking with the interest rate cuts. So a lot of positive things that should rub off, and we should catch up with the world sooner than later, is what I think.
So, as per your perspective, what will be the outcome for Indian market in a broader perspective? As per the tariff news, if it comes in a positive way, so what will be the intermediate effect on the uh, market on that?
I mean, it removes a huge negative, right? So the first thing you get is short covering. The second is then you try to think, how is it good for us? So some people asking that question on Twitter, trade weight ho gaya to kya? Apne ko kya farak?
Hmm.
Like that's not understanding the big picture. If we, I mean, after all, see, there is a part truth and not truth. Part truth is, yeah, these tariffs are for imports into US. So how does it affect India? We are only selling them goods. They want to put a tax on it and sell it to their domestic investors. Who cares? Do what you want. The only difference is if it becomes competitive. Like, for example, do the tariffs make US production competitive? I don't think a 25% tariff will do that. So in that sense, they will continue to import goods from India, even at a tariff. And therefore, it won't affect overall demand for goods unless US demand slows down, unless there's a US recession. And right now, there's no data suggesting any US slowdown. In fact, the recent data last week of retail sales and one more data point, I think both were actually good data points. Both were showing still strong growth in US. So we're really not getting any signs of slowdown in US growth. So if that is not there, then how does tariff really affect us in terms of demand? It doesn't. So that so unless there is a higher tariff on something which they're restricting, and it's a trade war, which is not the objective here. In fact, I have gone out and said in Feb that forget trade war. This is the reglobalization. Okay, and I've tried to spin a positive tone to it. And when I say reglobalization, what I mean is that you see, there were a lot of inter-country tariffs. What Donald Trump is really doing is bringing those away. Just like in India, they are in agriculture. They're so similarly, there are many in Europe also. Which is why they keep complaining that Europe sells us more goods than they buy from us. That's because Americans are not able to sell there. There are various restrictions. Same with Japan. Many of the restrictions in Japan have been removed. That is why this deal is taken so positively. Now, what does that mean for US? It means that if US is able to sell more of its goods in other parts of the world, its growth story remains intact. And because US is the net consumer from places like Japan to China to Europe, it also improves their demand environment. So there's a circular effect. And that is the whole thing about globalization, right? So if you go back to 1991, India had lots of restrictions on imports.
Right.
When we removed them, did that lead to the end of India? I mean, that's what people were scared of. Domestic industry will shut down, etc., etc. And that is why we left some tariffs in place. We didn't completely go to zero, but we went at least from 100% to 30%, and then 20%, and then 15%. In some segments, we have done away with import duties up to certain limits. In some parts of the market, they still are there, but the levels have come down by 70-80% compared to what they used to be. So did that lead to more trade or less trade? The answer is more trade. Okay, so opening up your economy is not always a bad thing, the way it is seen, because then you get competition, which leads to better productivity. You create better products, consumers are more happy, they consume more. The only thing is, if you consume more from outside, you need more currency to consume. That is the only odd factor. out here. So then you need to export better to be able to get that currency. I think that currency is a bigger problem with India, places like India where we are net importers. So if you get more US goods getting sold into India, how would we handle the
Then
exit of on the currency side if that money has to go back? That's a capital account and trade account kind of question, and we've always been restrictive about opening up our capital account because of fear that hot money might flee someday, like if FIs keep selling aggressively, like it happened in Southeast Asian crisis in 1997. So but on the trade front we are pretty much open. So yeah, the only thing is our trade being a deficit is funded by other flows, which is the capital account, which is restrictive or has limits. So we're a very unique situation, very different one from China, where mostly it was FDI. They allowed foreign investment, and FDI is long term, right? Once you set up a factory, the money is not going out, and so it led to
right.
huge reserve accumulation in China at that point of time. India doesn't attract that much FDI. I mean, it has increasingly over years, but not to the scale that we've seen in China. So we are very much dependent on portfolio flows, which is also considered hot money. And that is the only thing that you have to manage in this environment where you open up trade and more foreign goods come into India. So I think I've explained the scenario. It will lead to more business. Okay, so in that sense, it's good for the economy, good for business, etc. You have to manage the currency side. That is the issue.
So you actually answered my first question without asking. My first question was related to this Japan tariff and that the surge price in the index going up because of that. So you actually answered my first question.
Yeah.
So
So yeah, true. It's all linked. Correct. So yeah.
right. So moving to the second question, sir, it's regarding your own strategies, your own trading policies. So let's decode your own style of trading. How do you analyze the stock before deciding to trade? How long do you usually hold that position? And how much capital do you use to trade, like hold the trade?
So somebody's incessantly ringing my bell, so I'm actually not able to concentrate uh, on the question. I think you just give me a moment.
Sure, sir. Sure, sir. So, guys, it's a request to you, like everyone. So, at the end of our session, sir will be taking three of the questions from you guys, and will be answering them on live. So, if you guys are asking any question, so be ask the question totally. Don't be a open-ended question. Okay. So, thank you.
Yeah,
Yes, sir.
can we just go over the question again, so I'll get a proper answer.
Okay. So, it's about your trading style. Okay. Till now, we were analyzing the markets, everything. So today we will analyze what's your trading style and how do you trade. Okay. So the question was, uh, how do you analyze the stock before deciding to trade? How long do you usually hold a position? And how much capital do you use to hold that?
Oh, that's a very loaded question. Uh,
Right.
Screening stocks, there are many different angles, but we are talking trading, so I will not go into how do you screen. For investing is different, for trading is different. We use what we call as the trade setup in strike. Now what we call that is a combination of the Bollinger Band, which comes automatically with the 20-day average. I use a 40 exponential, so everybody sees that in our posts online, even on social media, and keeps questioning why are we obsessed with this 40. I don't know. You can obsess with 50 if you want. It's almost the same. What matters is that how you use it. And in moving average theory, you have to use two different time frames, one lower, one higher. So 2040 or 2050 is not the issue. Question is, are you using a lower and a higher time frame? And lastly, we use the RMI. Of course, the RMI is our own momentum indicator that triggers buy and sell signals. But there's also a last overlay for me, because most will know me as an Elliott wave theorist. And Elliott wave analysis, which is the wave count of the stock, also plays an important role, or the index, where it is in the overall picture. So when we're actually scanning for stocks, we're looking for stocks that have impulsive waves and are giving you a pullback to enter into, or at the early stages of starting a new impulse, which means previously there was a wave 1 and a 2 and a 3 is starting. So you're looking for those kind of opportunities. Now, if it is right at the bottom, it would be interesting to see patterns, for example, a triangle, okay, or an inverted head and shoulders and things like that. So there are a lot of many small parts. But I do, now that we've introduced swing to everybody, that has become a very, very important tool, because I find that instead of searching ideas all the time.
Your is getting.
My audio is breaking or something. Yeah, is that better?
Yeah, I'm very sorry for the interruption. There was a network issue from my end. So
Oh,
while you
okay.
were speaking, your voice was cracking down. Okay.
Yeah, now is it fine?
Yes. Ah, it's fine. It's fine.
Okay. So yeah, so stock screening. So I use the RMI scanner also. So everything now that we do, that I used to do, and there are many different ways to come down to stocks. So I'll just share the screen. That makes it a little easier than just talking about it. I'll go to a white background. Okay. So one thing is knowing where the market is. Okay, because you want to buy stocks when the market is going up from going bottom to top. So we've made the swing indicator as our go-to tool for identifying those points. So whenever we reach down here is when you want to start the trade. Okay, now whenever you're here, you want to look for stocks to buy. What stocks to buy. Now, to decide what stocks to buy, there are 2-3 different processes that we can actually have. One of them is simply going to the scanner, okay, the RMI scanner. And in the RMI scanner, if you're looking for stocks for 4 to 5 days, okay, what I call as one hourly RMI cycle is essentially combine the daily and hourly. Okay, choose a basket. So here we need to choose what basket we want to trade. Now, typically, if you want to do both long and short, you will choose the FNO basket. So instead of only indices, you will do FNO. So that means all FNO stocks, okay, not just a particular segment. And then within that, what I'm going to set it up is say that which stocks are giving me, which stocks are in buy mode, okay, on the daily chart. And out of that, which stocks are giving me a new buy signal. Okay, so if I simply took all, then it would show me all the signals on the hourly, but I only want to know the new buy signals. Now, the advantage of this is that it will look for a stock that is already bullish. Okay, so like you see here, Bandhan Bank went up, it pulled back. It's already positive on the RMI, though the RMI is falling, but it's not given a crossover. And then on the hourly chart, it starts turning up again. So therefore, this is like a first level thought that okay, can this be a 1, 2, 3 kind of a setup on the wave count? Now that is what I have to verify next. Okay, also you'd want to verify, are you at a good retracement level, for example? So we put this on and then we say, oh, is it at 61? Did it take support at 61%? Okay, so these are a couple of things that we'll check for when you're looking for this. And I'll also look for whether it's turned positive. Like here, it's after 2 down days, it turned up from a 61% retracement, and from, say here, this blue line is the 40-day average. So see how many things come together, and that is when then you consider, okay, that fine, this can be a trade, and this is what I should do. And we try to do it on the same day, and that is why I use something known as the live mode. The live mode basically tells you where the signals are coming today while the market is closing, on a closing basis. So I don't really like to wait for tomorrow morning. I think that if the signal is coming today, you should do it today, even though sometimes it's possible that many times we will have this experience ki buy signal aaya agle din niche ho jata hai. Sure, but there are many times when it will gap up and you miss the entire move, or the risk reward ratio becomes unfavorable. So therefore, very important that there's a back test which actually shows that more than half your returns come from overnight gaps. So you're actually giving up half your returns by waiting overnight on a signal that happened on the same day. And I've backtested it to see the return difference. When I was doing a model on index futures very long back, running a PMS on it, and the backtest actually showed that if I buy at the open tomorrow versus at the close today, my returns would be half. So therefore, that's a clear sign that you have to do this in active markets. When you're trading, you have to find the ideas during the day and then be prepared to execute at the end of the day. That is how it works. But what you also should have understood here is I'm using a 2 time frame concept. And what a 2 time frame concept means that we are using the daily and intraday, okay, daily and hourly in this case, to confirm what is happening, that the trend on a higher time frame is in line with the signal on a lower time frame, and that is what we are then executing. So this is one model. I mean, we can come up with more, but this is one of the things that I do to find stocks every day, and that's a process. You have to incorporate it. You have to just repeat and rinse every day. So it's not even that you have to think. I've already given the pointers. If those are the pointers are in your head, all you're doing is just looking. You just saw that out of 250 FNO stocks, we are down to 3. That's the capability of scanning on strike, right? And you can do it in less than a second. You just click and if I leave it like that, it will stay like that. See, I just close strike. If I even go to another screen and I come back, it's going to stay. So it will even change the stocks in this filter that I just created as every hour goes and every day goes. So very interesting. You can just come back and keep looking at what is showing up. Does it make sense? But people should have also understood that there's a top-down process in this that I did, which is that first I looked at the index and then I went to stocks, right? So basically my market view has to be positive to search for bullish stocks, or my market view has to be bearish to search for bearish stocks. And then I do the scanning on the bullish or bearish side, looking for ideas in the direction of the market trend. So this is now in a nutshell what you need to do.
Okay, that means you're going in a funnel way. At first, you set the indices, then the stocks, and then it merges down to a single stock. Yeah, nice stuff. The approach is very nice. So moving to the last question, that is our third question. It's a situation-based question. Okay. So suppose Nifty gaps up above 28,000 on a Monday morning, breaking a key resistance zone. But by midday, Bank Nifty start dragging. FIIs are net sellers for the 5th day in a row. And big giants, like giant stocks, we can't take the name, but very, very big stocks, okay, are showing weaknesses. You are already long since last week. So in this moments, what signals are you watching to decide whether to stay in the trade or exit?
So a lot of the things are noise, like FIs are selling for several days is noise. Large caps are showing weakness. Okay, that can be a concern if you're holding Nifty positions and they're mostly large cap driven. I may look at whether I have a clue in mid and small cap, but recently doing that didn't work. Like in the last 2-3 weeks, the Nifty has corrected for 3 consecutive weeks, whereas the small and mid cap have been sort of flat. So by looking at them flat, thinking that the market won't fall did not work. So that can be a little tricky, but there are times when there are intermarket divergences and it results in a market bounce back also. So this may have been an outlier this time. It doesn't mean that it doesn't work in looking at both the main market and the broad market. So if you look at both and look at divergences between the two, that is one which gives you a sense. Lastly, you come back to the trade setup. See, either on the daily chart or the hourly chart, you have to decide what was the purpose of this trade. When you took it, surely it's jumped up, gapped up, so that means you're making money. And then it's selling off intraday and you're wondering whether you should hold on to it or not. The question is, when you bought the position, was it going to be a positional trade? Positional trade meaning that were you attempting to ride the entire move on the daily chart if it lasts for some time? Okay. Or, did you buy it very, very late in the cycle? So that is one part. So if you bought it with the idea that you are going to ride an entire bullish RMI cycle, then you want to actually hold on to it even though there's intraday volatility. But if you want an intraday stop, you could use something like the 40-hour average or 50-hour average And if it breaks below that on an hourly closing basis, I would say, okay, fine. It's not maintaining enough strength. Maybe I want to either reduce or exit. One of the two decisions would have to be taken. Now, if you think that the daily chart is still very, very strong, you may just reduce by, say, 50% or 25%. Okay. So you reduce 50%, let's say, because the 40-hour broke. And there's too much volatility, and you don't want to deal with the idea that next day it gaps down and you gave up all the gains that you made because of the gap up. So you could trail with on the hourly average. So essentially here I'm doing something similar to what we discussed in the previous segment, that we are using two time frames to execute. One is the daily and one is the hourly. Okay, because the hourly is where you're executing a trade. Okay, and the daily is where you're trying to determine whether the trend is still intact. Okay, so you're doing the risk management on the hourly, and on the daily you're just looking at what the bar looks like. Does that change the overall trend? For just does one day's movement change a signal? Like yesterday an RMI buy signal may have come, but today, just because the market is down, does it mean that the RMI goes into sell? And if not, that doesn't change my view. It only means that I got some drawdown. So then that drawdown can be managed on the hourly chart. Should you reduce some because the hourly is giving a sell or breaking the 40 or something like that? Should you reduce a little bit on something on the lower time frame? So the entire execution will remain on a lower time frame. That is how you will handle it.
It's very deep thing. It's a long,
Very
long
intense it is. So it requires your attention. You can't say that
and also
I'm
patience.
trading, but I'm on the job and I got to attend a 2-hour meeting. Then don't trade. This is not trading.
Right.
Is not.
It
But you can
requires
do.
it requires patience as well, and
No,
good
but you
amount of
can do so.
patience.
Then you go to positional trades. Okay, so this is where the mindset has to change. What I have just explained is the short-term trade, which typically lasts for 5 days or max 10 days in terms of holding period. But moment you take a positional trade, which means you're willing to hold for a month or more, then you're only focused on the daily chart. You forget the hourly chart. And on a daily chart view, your view will not change every day. So you probably watch the market once or twice a day and decide whether the trend is still okay. And at the end of the day, at least, so you have to make time at that 3:15 to see whether the closing price is not breaking anything or changing your trend or giving a sell signal to exit. And if it is not, then you're fine. So this is where your approach would change a little bit if you are slightly positional. So if you don't have time and you still want to trade, choose positional. Definitely avoid intraday altogether. Go on with the questions.
Yes, sir. So there has been slight up and down in my network today. I don't know the reason. So yeah, uh, that's it for today's question. Let's move on to the questions asked by our audience.
I think you are getting stuck again and again on your network.
Yes, I'm back, sir. So here in Bangalore, it's been raining since morning. So there is a power shortage over here. It's coming and going. For that reason, there is the inconsistency in the internet connection over here. Okay, so let's move to the questions asked by our audience, sir. So first question from Vimal, percentage of stocks. So he's asking about.
Just a second.
Sure, sir.
Percentage of stocks in RMI: buy only 35%, stocks above 20, SMA down to 47%, some divergences, or are we missing something? Even if today both Nifty, Bank Nifty are up. See, when we look at an indicator like, okay, let me just share my screen. So when we look at an indicator like this one, the percentage RMI buy, that's a diffusion. Okay, what we are really looking at the trend, like it gets oversold here or here. Okay, these are points from where the buying happens. So from here, this oversold region, we are slowly moving up. Now today's reading is 33. As long as it's in a upward trend, that is the more important thing. Unless the trend changes. So usually I would expect that from here to here it moves up. Okay, and then once it starts moving up, you shift your attention from the indicator to price. So as long as prices are making a series of higher high lows and higher highs, you trail your view upwards and hold on to that position. So the number 33, is it a positive divergence, negative divergence? Nothing. It's an uptrend. It doesn't matter that it went up and then came down, because it's coming from a bottoming region. So for example, somebody may say, oh, it is down here, okay, and therefore it's a negative divergence. Maybe this is what he's saying. But what about this? When it actually bottomed here and then made a lower low, we made a positive divergence. So what should I give more importance? The fact that we got oversold and got a positive divergence is two things weighing on the upward side. This negative divergence, if it came from the top, then it would be important. Over here, I wouldn't really consider it important.
So moving to the next question is from Dheeraj.
I think
It's just stock. Is it a stock specific question, right?
no, not only that, but there is an obsession with flag and pole here.
Flag and pole.
Wait, I need to open it on my. What happened? My screen share was there, and then it disappeared.
Yes, sir. Now it's presented. It's visible, sir.
Because if his object of his question is to keep asking about what is a flag and pole, and me verifying whether it's flag and pole, there is a possibility, but again, it's not picture perfect. See what happens with slightly medium term patterns. Like this is a ideal flag and pole situation. Okay, but here you have a break outside on the upside and on the downside. So it looks like an attempt to break the flag on both, but you did eventually break on the upside. So we can call it, just because you have two touch points on both sides. Okay, which is at least from here to here and here to here, because we have a couple of touch points. We can call it a setup that it's a flag, even though there's a slight what we call as a false breakout on both sides. You'll have to wait. Just give me a few minutes. Yeah. So yeah, I think we can call it a flag and pole. That's about all I can say.
So moving to the last question for today's session.
No, RMI crossing the zero line is not a buy sell signal. The RMI has to cross the red average, right? There is a average along with the RMI. Let me just show that. So when we look at the RMI, there's a green indicator is the RMI, and red is basically a 9-day exponential average. It's the crossing of green and red that is buy and sell. If the green goes above red, it's a buy signal. Now, whether you crossed at zero, above zero, that's a different thing. That is the theory part of it, how to use it appropriately. So ideally you wait for it to, the best signals are when you return to zero and then you get a signal. But does that mean that a buy signal below zero versus a buy signal above zero are different? No, they are both buy signals only. But the green line crossing the zero is not a signal. It has to crossing the average. Crossing the red line is the signal.
So that's it, sir. That's it, everyone. So this is a wrap up for today's session. We'll meet you guys again on Friday, same time. See ya. Thank you.
Thank you.